excited because today we have our good friends and partners at Calamos joining us to demonstrate how working with an experienced ESG investor can help you maximize your opportunities. So it's my pleasure to welcome Barry Livingston and Mike Miller.
Leah, that's wonderful. Thank you for the introduction, and thank you for everybody on the call. Mike and I are going to give you an update and speak a little bit about sustainable investing within the context of a retirement plan. For a little bit of background, so Calamos is a longtime partner with RPAG. Calamos is based outside of Chicago, $40 billion firm, 40 years old, privately held. The ESG sustainable team that Mike Miller is going to speak about is has a 25-year plus duration of investing in this type of asset class. So we're not somebody that's new to the game. One of the things that we want to bring to the table, I guess, is just to talk about the adoption of sustainable investing within the context of a 401k plan is still in the early innings, but the interest, I think, is going to be a lot higher than you think it is. Mike and I have done a lot of work in this area. Mike knows the space very well, both on the retirement side and the sustainable investing side. So we're going to walk through this. And like I said, I think there's a lot more interest out there. There's a lot more people that have questions than maybe everybody recognizes. So with that as an intro, Mike, I'll turn it over to you. And then Mike, tell me how you want me to run through the slides, please.
Sure. Barry, if you'd go to the next slide, that'd be helpful. Good morning, all. Pleasure to be with you. Let's make this interactive. So if at any point you have a question or you'd like clarification or you'd like to make a comment, please do so. Secondly, let me comment that this is a big topic. In preparing this presentation, I look back over everything that's been written in the financial press relative to DC and ESG, and use that information to generate the comments that we'll talk about today. You know, we've thought about this from how to add value to you on this topic. And Barry, if you turn the page, go one more. We ended up with this kind of an agenda, and again, thinking about adding value to you. Going through all the content that's been written on this topic, ended up coming up with a couple of the major, there's 11 major themes that I've identified, and I'll discuss them at a high level. Each one of them could merit its own seminar. The second thing I'll talk about is underestimating demand, and the observation that I made is that wealth management and DC ESG are in almost an identical place. And I'll show you a couple slides that support that, but it essentially is the disconnect between the advisor and what they think the investor is interested in, and the advisor commenting that investors, whether it's a sponsor or wealth management client, don't seem to have an interest. And yet, when you survey either sponsors or investors about their interests, it's an overwhelming interest in learning more and wish somebody would discuss it with them. I'll give you some information about ESG that I think is the practical information that will help you navigate the space. I'll talk about some of the AUM in the space so that you have context to understand how to put these numbers into perspective. And then I'll give you a couple of closing comments about how we can help. Barry, if you'd advance, please. So first point about ESG, again, after reviewing the topic, these are the themes that I think that should be on your radar screen. First thing is, and I've already touched on this, there'll be a couple slides that will make this point in more detail following. So it is this underestimating investor interest and demand. Item 2, no official industry standard metrics. One of the observations that I made as I'm reading all these articles is that the key metrics for this space that you're going to want to evaluate and that you want to know that aren't available are number of plans that have an ESG option. When there is a plan with a with an ESG option, what is the adoption rate? How many of the potential investors make an investment? 3, when they make an investment, what percentage is it? Is it 1? Is it 5? Is it the majority of their AUM? And then 2, and then lastly 4, in the plan's total assets, what are the ESG values? And so I call those out so that as you read articles, it's so easy to have somebody cherry pick any one of these and indicate it's a trend. And so the observation I'm making for you is that 1, you can't find those numbers for the industry, and 2, those are the key numbers. And as you read and understand the space, focus on those. Third one, and this builds on what I just said. As you read articles, you will see anecdotal metrics regarding ESG adoption and usage, and they tend to be unimpressive. There are some positive trends, and I cherry pick some of the comments that I have to illustrate my point relative to unimpressive. P&I, pension investments, June 22, quote from Plan Sponsor Council of America. The utilization of ESG funds indeed appears to be anemic. According to data from the Pension Plan Sponsor Council of America's latest annual survey of profit sharing and 401k plans, in 2020, less than 0.5% of total plan assets were invested in ESG funds. The funds posted an average asset allocation of 0.1%. And while ESG investing has gotten a lot of buzz, advisors say demand among plan sponsors is also low, an observation supported by the PSCA. Plan advisor in a 1022 article quoted Callan, 1.2% of participant average allocations are dedicated to the ESG option. Vanguard 2021 found that just 6% of the participants were using the available socially responsible fund. Russell Investments 2022 surveyed 28 of its largest US-based DB and DC clients, found only 2 of the 28 were using the option. So the back to the point, the metrics regarding usage tend to be unimpressive as per those. They cherry pick what we built on earlier relative to what the plan metrics are. I will tell you that there are some positive trends on the horizon. Fourth point, we all know that TDFs and QDIAs are where a meaningful amount of plan AUM goes. And you then would lead to, rather than including a fund, is there any ESG are there any TDFs and ESG TDFs and QDIAs? And the answer is that there's only one mutual fund complex that has a 5-year track record. I would tell you that there are a handful of other firms that are in the product development area to build these types of products. But at this point, as you as practitioners would know the importance of those options, there's very little that is in a target date fund type of structure. It's more individual funds. The demand for ESG investment options will grow. It's consistent with the U.S. Retail ESG growth numbers. Let me give you, and as you read articles that discuss the demand for ESG investment, invariably what they will do is they will build their case based on what the retail investors investment behavior is in ESG mutual funds and ETFs. and they'll show the AUM that is over, year over year, and then they'll show the number of funds. I would point out some quotes that caught my attention. This is from Nuveen, who does a ESG DC summary, but it won't be long before this starts to shift. The reality is that a lot of sustainability and ESG investing has been done at a high level by sophisticated institutional investors. But now, gradually, I would say it's being democratized. Average individual investors are learning about it and really demanding to have these options in their plan. And that was a person at Nuveen that heads up DC ESG. Point is, DC ESG is going to continue to grow. And then last point on this page is Gen Z and millennials are increasingly a larger voice as it relates to DC plans and their investment options. Gen Z, and there's a lot written about this, they think and they invest differently. At a high level, they want to align their investments with their value, and their leadership at the plan sponsor level relative to the plan design, the investment options, the interest, and the influence that they have is palpable. Let me see if I'll give you a couple of quotes that I think capture this. Recent studies about the concerns of Gen Z and millennial investors indicate that they're worried about retirement and care deeply about investing their money according to ESG principles. Meanwhile, anecdotal evidence suggests members of these generations are becoming more vocal about having the option to make ESG investments inside their retirement plan. Plan sponsor, September article of this year, quote, Dave Nadig, a financial futurist at Verify, a financial service firm, says companies should ensure that Gen Z and millennials are represented on committees that advise the retirement plan. This can boost participation and helps companies understand what the cohorts want. Plan advisor in October, this is from a quote from Callan, nonetheless, participants' interests and the segment's growth aren't reflected in many retirement plans, and the availability of ESG options varies widely among plan types. The takeaway should be Gen Z, where is the puck going? Gretzky, Gen Z and millennials don't invest like baby boomers. They not only don't invest that way, they think about it differently, and they're going to increasingly be influential either on the committees or as a vocal participant voice to sponsors. And another point here is that they look for their company to have values that align with their own values. And it doesn't just stop at the company corporate purpose level. They're also looking to see that in their retirement plans. Barry, next slide, please.
Yeah, so Mike, hang on for 1 second. So I asked Mike to kick off with 4 or 5 bigger topics with the idea, again, we're in the early innings of adoption, but there's higher interest than people may think. So Lee, I don't know how we're set up, but are there any questions? Can people ask any follow-up from Mike if anybody has some more information they'd like?
Yes, they could submit them through the chat feature right now, through the Q&A chat feature. And then if there's any questions that may come up, maybe after the webinar, they can reach out to us at support, RPAG support, and we'll be able to get them in front of you for any follow-up questions.
So that's wonderful. If they have a question, do they ask that orally? Can we hear those questions, or we have to get them through the chat feature?
No, their lines are muted. So like I said in the beginning, if everyone's lines are muted besides ours, and then if you have any questions, they can submit them through the Q&A feature, and we'll be able to see that.
All right, so you'll see it and you'll let us know. Is that right?
Yes.
Fantastic. All right, Mike, page 2.
The points here are ESG investing is not slowing despite the state pension plan media visibility. So I think that we're all aware of various states, their treasurers, and the media coverage of their plans to no longer invest with certain managers that have certain positions relative to ESG. And so it's easy to hear and read about that in the press and think that ESG investing is really slowing down. And I thought that this was interesting. PwC released a study in October of this year. And the quote is, "Demand for sustainable investments is outstripping supply. New research suggests, in contrast to reports of a growing backlash against investing according to ESG principles. A new study by PwC found that nearly 9 in 10 institutional investors believe that asset managers should be more proactive in developing new ESG products. Enthusiasm for ESG, PwC found, is high in every region of the world. For example, 81% of institutional investors in the US plan to increase their allocation to ESG products over the next 2 years. PwC expects ESG-oriented assets under management to grow much faster than the asset and wealth management market as a whole. It forecasts the compound annual growth rate of assets under management held by ESG mutual funds and mandates between 2021 and 2026 will be 12.4%. So observation there is, so much visibility in the press about the states. And so what is that doing to ESG interest as well as AUM flows? And this study would suggest has not put the brakes on it. In contrast, it's actually continuing to grow. And we'll look at some ESG numbers later, global AUM, to give you some perspective. Then the next two topics are hot takes. Hot takes is a phrase from the sports world where, talk shows are trying to create, create a topic that creates a lot of interest and calls in. So, both of these I characterize as hot takes. So the first one is early ESG adopter profiles. So it's kind of trendy to see articles, and they'll talk about, what is it? What is the profile of the plan sponsors that are adopting ESG in their DC investment menus? And I'll give you the punchline first. Purpose naturally aligns with ESG factors. A quote from T. Rowe Price: "Most of the ESG implementation so far has occurred in plans at organizations whose purpose naturally aligns with ESG factors," says the senior DC strategist for the America division of T. Rowe Price. Think healthcare or religious organizations for the most part. Tech companies also tend to be more interested, she says, adding geographically, the interest has been concentrated in the Northeast and West Coast. DCIIA says strong ESG interest from higher education, healthcare, foundations, not-for-profit firms. Millennial and Gen Zs are the most active employees. So that's kind of a hot take. I would look at this and say, it's a little bit of sizzle. Think Gretzky, think where the puck's going, think where ESG investing is going, and think about the age demographics of the constituents and the plans. And that's that I think is going to drive the AUM more than this, although this will continue to get, some coverage in the press because it's, it's trendy. On the other side, it's trendy to see articles about sponsor pushback. So, what is the resistance? What are plan sponsors saying in response to ESG? And DCII did a article and a paper this year, and some of the what they captured in terms of resistance to adoption was lack of consistent values across plan participants leads to difficulty in making appropriate fund selections. Insufficient employee demand leads to delaying consideration. Shifting political and regulatory environment has led to uncertainty. Lack of focused or compelling corporate ethos, avoidance of bleeding edge, i.e. plan sponsors are hesitant to be early adopters. So point being, it's not hard to find articles that give the sponsor view about why they have not adopted ESG. And our take would be, or our position would be, if you run into that and you'd like support, we're here to help you tackle any of those topics. DC ESG adoption positive trends. I talked about, it's the unimpressive stats relative to adoption so far. However, that there were some positive trends coming down the pipe. On the positive trend, I would, Alan has a quote that their head of the ESG anticipates that the DOL will issue its final rule this December. Consequentially, he expects more adoption in 2023 and 2024. Plan sponsor stats seem to support the optimism. In 2021, only 8% of plan sponsors included ESG investments in their plan items, but 31% were considering adding them in the future. And that's from Callan's 2022 Defined Contribution Trends Survey. I thought this one was interesting. This is Brock Johnson, Morningstar's Chicago-based president of the Retirement and Workplace Solutions Group. He is encouraged by the robust demand for ESG investment options outside of retirement plans, saying it's only a matter of time before the appetite for ESG in investment and IRA accounts on the retail side spreads to the institutional side. We think that's going to eventually get to the DC space. We're seeing end users wanting to know more and more about what they're investing in. Last point. ESG investing is the holy grail meaning if you offer ESG investments, participation increases. And there was Schroders, well-known asset management firm, produced research this year as part of their study, and that indicated that, had positive stats, with the conclusion being, geez, if you add ESG, you have the opportunity for participation to increase. I'll give you the quote so that you have the proper context. Plan participants in this group want to align their investments with their values, particularly those within companies that have made commitments to sustainability-related initiatives. Companies that have set sustainability goals may continue to see a rise in demand from employees who want to see consistency between those commitments and their retirement options. Research published earlier in this year showed participation would likely to increase if sustainable investments were offered. A P&I article in June of this year, building on this, provided these stats. 87% of DC plan participants surveyed by Schroeder want their investments to be aligned with their personal value. Of the 31% of 401k plan participants surveyed who knew that their plan offered ESG options, 9 out of 10 invested in those options. Almost 3/4, 73%, estimate that they allocate 50% or more of their plan assets in the ESG options. So, it's not as though that's a broad-based conclusion, but that kind of data is being gathered. is being promoted, and it's worth noting that that's a theme that we'll continue to I think we'll continue to see show up in media coverage and plan behavior. Barry, if you turn the slide.
Mike, I will. Lee, are there any questions that have come in? I mean, Mike has got a lot of additional information that we're going to share, but I asked him to put his big points up front just to stimulate some conversation. And to the extent that there is conversation, there's questions, we're happy to address that now. Otherwise, he can go through and continue to talk about this. But let me pause and see if anyone has anything they want us to add.
Yeah, no questions yet, but to those on the call, if there's any questions you have so far, feel free to type those in. We'll give you a moment here.
Thanks, Lee. Thanks, Mike.
Yeah, and point of this slide before we change topics is I think this is backdrop and context that I think it's important to know. This slide was produced by Cerulli. It was produced in 2019. I think it's noteworthy. But the point of the slide is that we have the largest redistribution of wealth in human history. And that'll take place between 2018 and 2042, and they estimate it to be $70 trillion. And it's coming from the Great Generation. And then you see the allocation projections by Cerulli to the millennials, to the Gen X, to the baby boom, and the trillions. And so when we talk about the different behavior, the investing attitude and actions by Gen X and millennials, this is supporting information that identifies the magnitude of the AUM, as well as supports the idea that they invest differently, and it's in your best interest to be aware of that. Next slide, Barry. I'm going to, I talked about wealth upfront, wealth management, and DC ESG being in a similar place. And this really struck me. This is from DCIIA in 2021 in December. And as indicated up top, they held 30-minute interviews with 12 DC practice leaders at leading US consulting firms. And here's what they had to say. Quote, "It's also interesting to note that not all plan sponsors proactively raise the issue of ESG investing. However, when the consultants ask if their client would like to hear about ESG, there is almost universal demand for information on the topic. Furthermore, the consultants reported that they each have proprietary methods of analyzing and identifying suitable ESG investment options." Now, I would look at that and say almost universal demand by sponsors to hear about a topic. If I'm in the prospecting business and building my book of business, I sure want to talk about something that sponsors have an almost universal demand for more information about. Barry, next topic. Or next slide, rather. This is the bookend that goes with it. This is the wealth management industry, and this is Cerulli doing research and a study, and they queried advisors, and they asked what prevented them from adopting ESG into their client portfolios. And we have the same pattern in that by far 58%, the most common reason offered was a lack of investor interest. And some advisors characterize ESG demand as a non-issue. Investors, Cerulli interviewed in retail investor households and found nearly half of households would prefer to invest in an environmentally or socially responsible way. The conclusion, Cerulli cautions advisors against drawing conclusions. Based on our research, advisors generally underestimate the demand that their clients have for ESG and should not interpret lack of proactive questions as a lack of client interest. So I just note the similarities in the discussion, in that the advisors, whether it's for wealth management or to plan sponsors, don't believe there's an interest. and there is a greater interest, and you should be aware of that. And even if you were, somewhat hesitant, but you just try it out, see if this holds true, we will be there to support you. Next slide, Barry. I'm going to give you a little bit about what I think you should know about ESG. This is a Morningstar source slide, and it captures milestones along the way. 1971 is their first milestone. And the point I would make here is that when you go, and I've looked at a number of these, they almost always, the topic of ESG investing almost always starts with values. And in this case, Pax Funds in 1971 created a fund and they had a couple of United Methodist ministers that helped create one of the first mutual funds that invested based on values. And so there's, key milestones along the way, worthwhile taking a look at, but that was the point I want to make there. Very next slide. When you boil this topic down, there are two reasons why people would invest in an ESG faction. And they are either values or there's investment reasons. And so the investment, and I'll show you a slide that'll make the investment reason more concrete, but the essence of it is, to the extent that non-financial factors influence the price of a security, and you've only analyzed financial factors in the past, but you now have non-financial factors, why would you not consider them? That's the investment reason. The values reason is pretty straightforward. Barry, next slide. Part of and again, this is in the context of, what do you need to know about ESG? It's fascinating to me that this industry with, $35 trillion hasn't figured out how to consistently label the various strategies. And this slide was created to support that concept. Noted organizations, this is how they characterize the various strategies associated with ESG investing. Your takeaway should be, geez, they don't all use the same language. Why is it so confusing? And the point here is to support you in saying this is one of the challenges, and it may be why people don't bring it up, because they haven't wrapped their hands around it, because there's no consistency. Next slide, Barry. What we attempted to do here was to make this easy. And so we've taken the strategy types under the category label, and the category begins with inclusionary, exclusionary, or best in class. Exclude bad companies, don't include them. Inclusionary, good companies, let's only invest in good companies. Best in class, let's identify the best practitioners and make that our portfolio. You see the summary and focus: avoid bad, reward good. Investment goals: values first, returns secondary. Integration is the concept of financial and non-financial information being incorporated in your investment management selection process. And you'll see that the investment goal is superior returns while incorporating ESG risk and opportunity. Mitigate ESG risk, identify ESG opportunity. It's just a broader way to invest. Third one down is thematic or impact or thematic. Your goal here is to affect change and contribute to solution. What's important from an investment standpoint: outcomes first, returns secondly, typically a non-core allocation. Very next slide. And so it's natural to think, well, if there's if there's 35 trillion invested in ESG sustainable fashion, what strategies have, where is the AUM? And the point of this slide was to give you context that the vast majority of the AUM is in ESG integration. And then you see the various other category or investment strategy types and their associated AUM. Next slide, please. This is this concept of incorporating non-financial and financial information in your investment decision making process. Integration is the name of the strategy, and the concept is the iceberg, and that things that are not financial information that you weren't incorporating can end up impacting security price, and variety of labels, call outs there, but that's the concept behind the slide. Next slide, please. We're going to shift. So we've done, what do you think? What do you need to know about ESG? And now we're going to do the numbers. So the first point I'm going to make out is at the bottom. This comes from GSIA, Global Sustainable Investment Alliance. They do a study every 2 years. And in bottom left chart, you see 2016, 2018, 2020. The bottom of the right 2020, you see a total number of 35 trill. Up at the top, you see global sustainable investments at 35 trill. When anybody in the financial press is writing about this, they always go to they almost always go to GSIA as their source of data for aggregate AUM. This slide's interesting because they then take professionally managed assets globally and take a look at the question of what percentage of total assets is managed in a sustainable fashion. And again, you're seeing the 2016, 18, 20 numbers, and you're seeing that their conclusion is that 35.9% of total assets, and they put that number, they estimated at 98 trillion, is invested in a sustainable fashion. Next slide, please. So, given, and this supports that concept of, geez, everybody's attacking ESG as per the state treasurers. What are the projected AUM? Where is ESG going to go? And this is Bloomberg study. As you can see, they note in conjunction with GSIA, they make a bear, base, and bull projection going into the future. And so, if we're at 35 trillion at 2020, beginning of the year, their estimates are that we'll be at 53 trillion by 2025. And that's consistent not just by Bloomberg, but all the other kinds of organizations that would make projections like this. Next slide, please. This is after understanding total. Now we get to the topic of, well, let's talk about mutual funds in the U.S. and in the world. And so this is Morningstar data as of March of 2022. First of all, institutional is driving the bus. Retail is a tenth to, or is 10% to 20% of that 35 trillion. In this case, what we have is Morningstar saying how much money, how many funds are invested in sustainable fashion. And and you can see it's from Q1 of 2022. You see the geographic regions, Europe, US, Asia, et cetera. You see flows, but I'm going to point you to the assets. So what we have is global retail AUM is 2.7 trill out of an aggregate of 35 trill. And we see that Europe has 2.2 out of 2.7 trill. The United States at 343 billion. And then you see it through via the number of funds. And so it gives you some perspective of the amount of AUM in ESG funds, mutual funds and ETFs, and relative to the global numbers. It shows you how far, Europe's leading the pack, institutionals driving the bus, and that, relative to number of funds, it's still relatively modest in the United States at 550. Next slide, Barry. Yeah, this one, this is Morningstar. It's December of 2021. And what this is, they do update on trends. One of the trends is AUM in ESG. or sustainable, and the bar charts show you the AUM. And so it starts with 2012, but the numbers that I highlighted up in the quote up at the top is in 2018, there was roughly $5 billion of AUM in ESG funds. And at the end of the year, from 2018 to 2020, it had crossed 20 billion. And the financial press was going out of their minds with quotes like this: smash previous records. And we see that it goes from 20, it goes to 50, it's almost at 70. And so you get the idea that ESG/sustainable investing is growing and in all likelihood is going to continue to grow. Next slide. This slide is a topic that shows up in the AUM numbers, and one of the ways to invest is passively. And so what role does passive investing play in ESG investment management as it relates to retail ETFs, mutual funds? And this slide, and you can do it by AUM, you can do it by number of funds. I used, and notice that the title of this is Buyer Beware, Passive Strategies May Not Provide What Investors Expect. This is to introduce the topic of, does passive make sense in this space? And I would point out the following. I would point out, one, that if you are a big passive manager and then you build ESG funds, this stuff looks rich to you because you can charge more than pure passive, which we know is incredibly, has incredibly low fees. And so this looks like a bonanza to passive managers because they can charge a premium over pure index. Now, what they've done, Jen, and then that leads to, let's analyze what a passive strategy might look like. And strategy one option is something that will be benchmarked to the S&P. They will essentially own the same stocks that are in the S&P. What they will do is they will identify within the constituency which companies are bad. They will continue to invest in bad, but they will reduce the percentage to be able to claim it's ESG. And then they will manage the portfolio in such a way as to try to weight the rest of these stocks in a fashion to get to the same investment characteristics as the S&P. It's the equivalent of, owning the cleanest dirty shirt in the hamper. And is this truly what an investor in an ESG index fund would think they were getting? The other way to create passive ESG funds is to say, we will not invest, we will create a product that will be passive, and we will use some third-party provider who determines, and whether it's an MSCI or Sustainalytics, what's good and what's bad. And what's interesting about that is that you're having a third party define what is a sustainable company and what is not. And they're applying their own logic. And the natural lead would be the same way that you would expect S&P and Moody's and Fitch to have a high correlation among their opinions as it relates to bond ratings, for instance, and issuers. You'll find that the correlation among the data providers is low. It's in the 0.4 to 0.6 range. So you're really getting one organization's values embedded in what is sustainable. And it's not a consistent analysis or it's not a consistent opinion across the industry. It's more idiosyncratic than that. Next slide. This is the greenwashing slide. And again, it's here to provide you context. The context is greenwashing is this fake claim that you're managing something in an ESG sustainable fashion when you're really not, but you want to get the halo effect of being green and this consequential economic potential benefit. And so as it relates to the US, And as it relates to mutual funds, the playbook was for a large a mutual fund company that had an existing fund that was not that was flat in terms of AUM or slightly declining, and to come up with a strategy to repurpose. And the strategy to repurpose was to go to the prospectus and say, now we are now considering ESG and sustainable factors in our investment process. And by doing so, they don't have to, this fund that doesn't seem to have much of a future, but may have a couple $100 million in it, they don't have to redeem and then create a new fund. They can take that fund, keep the shareholders, notify them that they're changing, and immediately they have a horse in the race. They've got a track record. They've changed it to green. And that was the playbook. Now, the regulators, leading with Europe, followed by the US, are now addressing this in a very meaningful way relative to, if you're going to claim that you're investing and incorporating ESG factors in your decision-making process, you're going to have to prove it to us and show us. And so, but this is the greenwashing. There's so much written about greenwashing. You can do a whole seminar on it. But wanted to give you the concept, and of course the title of the slide is, "Are your managers really ESG?" Very next slide. Conclusion. Calamos has a ESG sustainable global public equity team. We manage a global and international and a US strategy. The team actually launched one of the first mutual funds in 1999. It was a global ESG fund. The name of the firm was Portfolio 21. These guys, they were country when country wasn't cool. They were ESG when ESG wasn't cool. They were a boutique. They got bought by Trillium, and ultimately left Trillium and are now at Calamos. These guys are the real deal. Not only investing for a long time, had to create their own proprietary methodology because there was no PRI, was no third-party data. Their track record is strong performance, lower risk over multiple timeframes. That team is, it's good to have that. It's really good if you're on your side to be able to access their information and their accessibility, and you have that with us. We are a resource regarding DCESG. We're a committed partner. As I indicated, have gathered information on the space and can support you. As the point below is, we can point you to information that we think, regardless of the topic that you're, evaluating, we probably can help. Happy to help, and can point and can provide perspective and information to help you address it. Last point, differentiate, distinguish, and prospect with ESG expertise and focus. So if you have an existing client base and you think they're not ready for ESG, but you're trying to grow your business, we know that sponsors would like to learn more. You have the ability to differentiate yourself. I don't think ESG is going away. And we will partner with you and work with you and support you in any way we can to help you be successful.
Mike, that was wonderful. Thank you for the update. Country when country wasn't cool. That's one thing I'll take away from this. But 3 points I want to make. Adoption right now is not significantly high, but we're in the early innings. The interest is significantly higher than you think it is. And as Mike talked about, Mike and his team have been doing this since the 90s. So this is not Johnny come lately. This is not, hey, we're going to relabel our growth and income fund ESG growth and income. It's something that we've done, the team has done for 25 years.